Hi, everyone. Thank you for joining us today. I'm Tom Redekop, Managing Director in our Business Law Group. My practice focuses on public and private M&A and cross-border mergers and acquisitions and capital markets transactions. I'm going to be your moderator for this session. Today, I'm joined by Darren Akers, a partner in our corporate practice based in London. Darren has extensive experience advising clients on complex cross-border M&A transactions, and his practice also covers joint ventures, corporate advisory work, and capital raising. Alex Farkas, a partner in our corporate group in the Toronto office, and also the co-leader of our national M&A group in Canada. Alex has extensive experience advising on complex M&A and private, both public and private, including arrangements, takeover bids, share and asset acquisitions, and restructuring. Rachel Howie is a partner in our litigation and dispute resolution group in Canada. She's the co-lead of the Canada Region Litigation and Dispute Resolution Group and the National Alternative Dispute Resolution and Arbitration Groups. Her practice focuses on international and domestic arbitration and litigation, primarily in the energy, mining, and natural resources industries. And last but not least, Andrea Steiner, a shareholder in the corporate group located in our Pittsburgh, US office. Her practice involves corporate transactional matters with an emphasis on mergers and acquisitions, private equity, and mezzanine financing. So why are we here? Well, I think we've all noticed that global M&A has cooled at least slightly during 2022. And this is primarily due to macro pressures such as inflation, rising interest rates, geopolitical unrest, and ongoing supply chain disruption. However, there are some countervailing forces such as lower valuations of target companies that are helping buyers to continue their global M&A. Dentons wanted to understand how both strategic and private equity buyers view the current cross-border M&A landscape. So we hired a third-party researcher to help us survey buyer perception of global M&A. In the third quarter, our researcher interviewed 150 senior executives involved in cross-border M&A. 75 of the respondents were Canadian or US acquirers of targets based elsewhere. 75 were acquirers based outside of Canada or the US, and they were acquiring Canadian or US companies. The respondents also included both private equity and strategic acquirers. All the private equity respondents surveyed had a minimum of $250 million US in assets under management, and all the strategic respondents had a minimum enterprise value of $100 million US. And let's go to the substantive slides. So what we're going to see on this slide and the next slide is that about a third of executives in Canada and the US, and about 40% outside of North America, expect the volume of near-term cross-border M&A to increase compared to the last 12 months. I'll start with you, Andrea. Does this reflect what you're seeing in the market?
Hi, Tom, and good morning and good afternoon, everyone. Given the significant deal activity in 2021, I would say deal flow, I agree, was definitely noticeably less in 2022. There still remains a lot of market uncertainty in light of various global economic and other factors. And some buyers, particularly private equity and financial buyers, might be impacted by the rising interest rates and finding it more difficult to obtain debt financing. So I'm not sure that there will be an increase in transactions over the course of 2023. However, in my practice, I am seeing signs of anticipated deal activity and deal planning for the upcoming year, which is all positive. Many private equity funds still have a lot of capital that needs to be invested, and other buyers with significant cash and other current assets without a financing need might seek out acquisition opportunities presented by the general economic turbulence. So based on this, I'm not anticipating a sharp decline in deal activity, but I do think deal volume will remain near or maybe even slightly below current levels for the next few months.
Thanks, Andrea. Darren, do you have any thoughts on this from across the pond?
I mean, what a world we live in, right? I mean, it's a real interesting, I think, interesting market out there. You know, an interesting market, a difficult market to really predict trends going forward. I mean, I think what Andrea has said and what you've said, Tom, is absolutely correct and holds true for the UK and Europe. I mean, I think we're 2022 seen depressed deal volumes for sure. But that in itself it is a hard one to sort of get your head around, because 2020 and 2021 were sort of standout bumper years for M&A, and arguably were 20-30% up on previous years. So the fact that 2022 is 20-30% down on 2021 isn't necessarily a sign of cyclical slowdown, and it might just be a normalization in the markets. But I think it's a bit difficult, probably too early to tell, I think, given where we are with the macroeconomic conditions. I mean, everyone will know about the situation in the Ukraine. Here in the UK and Europe, we're looking at rising inflation, quickly rising inflation, rising interest rates, a significant energy price crisis, which is looking or entailing quite a lot of government intervention. So, all of those sort of things would tend to suggest that it's a depressed economic climate, and therefore depressed M&A activity. But the counter to that means there's pretty volatile currency rate, and again, it won't be a secret to many people that the sterling at least is down a lot, or has dropped a lot and weakened a lot against the dollar over the last few months, and because of the macroeconomic environment, stock valuations, and in particular listed stock valuations, are significantly down. So all of those things tend to suggest that UK and European targets are, or companies make good targets for buyers from offshore, because it's a lot cheaper. The currency is a lot stronger, so it's actually cheaper to buy assets, which may then drive M&A activity. So I'd say hard to predict. My overall perception, and I think what we are seeing with our clients is similar to what Andrew is seeing. I think it's slow at the moment. I would expect subdued volumes of M&A activity, at least in Q1 and Q2 next year, and we'll see where it goes after that. I mean, there are signs of life, and I certainly, some people are, there's a lot of doom and gloom out there, but we're not seeing a similar trend to what we saw in 2008, 2009, 2010. I think there is life, things are moving. It's not an absolute cliff edge just yet. So it's hopefully more positive activity towards the end of next year.
Thanks, Darren. So when we think about what's driving M&A, or what might be driving M&A, the top 3 drivers from our survey participants over the last 12 months were pursuing digital transformation, expanding into new growth markets, and scaling up to become more competitive. What top M&A drivers are you seeing from your clients? And do you anticipate any changes for 2023 and beyond? Darren, why don't we start with you on this?
I think I sort of tend to agree with the majority of respondents. That they sort of know better than I do, but digital transformation and scaling up, I think, remains key to clients to our clients, and those have probably been the most prominent drivers for deals that I've seen over the last 12 months. Digital transformation and what I call kind of innovation by acquisition is so prominent. The rate of change, the pace of change, and the pace of innovation in technology is so quick. It's really hard for corporates to keep up, and therefore, often the only way to keep up with innovation is to acquire new technologies, and so I think that that continues to be a real driver for M&A in the sectors we're seeing. I think some of the other drivers we've seen and continue to see is supply chain issues. I mean, I think the pandemic, as well as China and other factors and more kind of macro factors, have really led some clients to look at the global supply chains and look for alternative supply arrangements, or put in place alternative supply arrangements, which I think is driving a measure of M&A. And maybe it's just here in the UK, but I think ultimately in the long term, the way COVID has played out and the way the pandemic has played out has really changed the way some of us live. Hybrid working, online shopping, it's kind of been accelerated, and some of those changes are here to stay. Some may not be, but I think those sort of changing both consumer trends and the way we live, I think, will also drive M&A as certain business models change and are disrupted. I mean, one example of that is for those of you who are familiar with the UK, there's a big retail chain called John Lewis, one of our clients, and they've recently just signed a partnership with a big real estate developer to turn a bunch of their old department stores into residential units, because no one's going to the shops anymore, no one's going to the big department stores anymore, but there's a housing crisis. So you'll see those kind of trends maybe developing and spurring M&A going forward. And ultimately, depending on the sort of more negative side of things is if there is an economic downturn and distressed assets, distressed valuations, I think could also drive M&A where there's fire sales and various other things.
Thanks, Darren. Alex, I'm going to pivot to you. What risk management strategies should deal seekers consider?
Thanks, Tom, and hello, everybody. In terms of risk mitigation strategies, this is clearly not a new phenomenon in M&A transactions. However, it's clearly become an increasingly important consideration given the uncertainty of the current market environment, and in an uncertain environment such as the one we currently operate in, we see parties paying increased attention to sort of 4 potential risk mitigation strategies, amongst others. And first off would be conducting an enhanced due diligence process. Interestingly, as we looked at the survey results, about half of respondents wished that they had devoted more time and resources to due diligence. And respondents in Canada and the US cited the technology and cybersecurity due diligence is the most difficult to complete in the past 12 months. And about 51% of respondents outside of North America were frustrated by IT due diligence. And regulatory due diligence was also identified as a key area of focus. And of course, with enhanced due diligence, there's also a trade-off, and especially in a new hybrid due diligence environment, such as the one we're currently living in. And that is, of course, the time and cost of the process. And so interestingly, our respondents, almost half of them indicated that their due diligence processes are taking longer than expected, in the range of 1 to 6 months longer. And what was interesting to me is that at least 30% of respondents were saying that their due diligence process is taking 3 to 6 months longer, which is a significant increase, and certainly something that would have a material impact on transaction timelines and execution risk. That said, of course, due diligence remains probably one of the main risk mitigating strategies, and one that will continue to be a focus. A second strategy that is often employed, and it's because it's getting more traction again in this market environment, is an earnout. And for those who are less familiar with this concept, of course, an earnout is just a form of deferred consideration that's tied to the performance of the business post-closing. And if certain performance metrics are met, then the deferred consideration is paid. Otherwise, of course, it's forfeited, or only a portion of it is paid. And this is really a buyer-friendly risk mitigation tool that can be used to bridge a gap between buyers and sellers on purchase price. And we look at 2021, and it was clearly a seller's market, and in seller's market, earnouts being a buyer-friendly strategy, they were less prevalent than before. But with the markets becoming increasingly balanced, earnouts are back in the spotlight as a key tool to make sure that buyers are not overpaying for assets in uncertain environments. And in fact, the survey response was supportive of the fact that earnouts are back in favor. It looked like almost 60% of respondents were expecting to use an earnout mechanic in one of their transactions in the next 12 months. So we'll keep an eye out on that. A third risk mitigation strategy, and this is not new, but certainly something that's increasingly prevalent in the Canadian market, is the use of rep and warranty insurance. And with buyers focusing on mitigating risk and sellers focusing on limiting their exposures, rep and warranty insurance has long emerged as a useful tool to bridge that gap. For those who have not used it, rep and warranty insurance will allow buyers to seek recourse against an insurer for certain breaches, as opposed to going after the sellers. And through the pandemic, rep and warranty insurance has continued to be extremely popular. The Canadian market has always been a little bit slower to adopt rep and warranty insurance, but certainly it's been a popular feature in our markets for the last 5-7 years, or even a bit longer than that. But we're lagging behind Europe and the US. Certainly seen a lot more traction now. And when we looked at the survey, almost 60% of respondents indicated that they have used rep and warranty insurance in their past deals, and almost half expected to continue to use rep and warranty insurance over the next 12 months. And interestingly, we saw rates becoming a little more expensive during the pandemic as a result of increased demand. But with the rebalancing of the supply and demand curve, we're finally seeing rates coming down, which I think will make this tool more appealing in the future. And finally, risk-averse buyers are well served to think about spending more time on post-acquisition integration earlier in the process. In fact, it looked like half of our respondents wished that they had put more emphasis on post-acquisition integration. We often see transactions guided by, closing checklists that often focus on the things that you need to do to get to the finish line, but have very few post-closing items on there, and certainly fall short of a fulsome roadmap to successful integration. And I think dedicating internal resources and including your counsel and that process earlier is paramount to maximizing the success of an acquisition. One thing that we have found very useful is creating an integration checklist that either supplements or runs in parallel with the main transaction checklist. And you'll be surprised, but there are lots of procedural efficiencies to sort of doing this in parallel and thinking about these issues at the same time.
Thanks, Alex. That makes a lot of sense. I'm going to turn it over to Andrea just to see if she has any additional thoughts on potential risk management strategies.
Yeah, I agree with everything Alex just discussed, and in particular, the significance of diligence being a risk mitigation tool. And the one thing I thought was interesting was that the respondents noted that regulatory and cybersecurity matters was a diligence challenge. And in connection with those categories, I do think it's worth noting that diligence relating to data and consumer privacy is likely to become more complex in the coming months and years, particularly in light of new regulations being implemented in various jurisdictions. For example, just in the United States alone, the state of California has a new data privacy law going into effect on January 1, 2023. That expands upon existing data privacy protections. And the states of Colorado, Virginia, Utah, and Connecticut all have new privacy laws of some form going into effect during the course of 2023. Also, on the private equity side, because there is more difficulty in obtaining debt financing and potential outside financing risk, I think it's possible that we will see an increase in the use of seller notes or other forms of seller financing in the coming year as well.
Thanks, Andrea. Why don't we go to the next data point on our slides, and we'll see that technology, media, and telecommunications has been by far the most appealing sector for potential cross-border M&A. It was cited by 72% of the US-Canada respondents and almost all of the respondents outside of North America. Our respondents also indicated that they expect it to remain that way. I know in my practice, I'm very busy with many technology transactions, and I expect that is going to continue for the foreseeable future. Alex, what do you see in your practice, and do you expect this to continue?
Thanks, Tom. I would certainly agree with you. We have certainly seen some softness in the capital markets and, of course, less IPO activity than in late 2020 and 2021 in the tech space. But this environment has continued to create M&A opportunities as some technology firms reassess their strategic direction. We would expect to see continued consolidation activity along with activity driven by the desire to stay ahead of the curve, as sort of discussed by Darren a bit earlier in our discussion. And with that said, just given the uncertain market environment, I would certainly expect to see a lower number of large transformative acquisitions in the space. And I would expect to see an increased focus on smaller bolt-on transactions that are more plug and play and that come with less overall risk and potential exposure as a result. But certainly, I think it will continue to be an area of focus for M&A activity over the next 12 months.
Thank you. I'll direct my next question at Darren. Darren, are there particular industries that will see more increase than others?
Look, I start off by saying, especially on the TMT side of tech side, I certainly agree with Alex. I mean, that's consistent with what we're seeing on our side, and I would expect that sector to remain strong. But I would say outside of the TMT world, I think what we're probably expecting is increase in energy transactions. I think the market is is in a real interesting place on that. I mean, there's there's high, although slightly falling today and yesterday, oil prices, exceptionally high gas prices, and exceptionally too much demand for the supply, which all tends to suggest that there's going to be M&A activity in that market. But equally, balancing that against net zero targets and energy transformation, which there's been some significant deals, probably less so in Europe, but out in Australia, where big funds have bought coal mines and other resource companies and looking to turn those into renewable energy producers or other clean companies. So I think we probably see that sector as being rife M&A activity, and will probably drive activity over the next 5 to 10 years, I would say.
Alex, how about you? What are you seeing in terms of industries? Do you think some will increase more than others?
Look, I certainly agree with Darren. In terms of level of activity, energy and natural resource M&A has also seen an uptick in Canada over the past while. And I think, just based on conversations with colleagues who spend a lot more time in that space, it certainly seems to be an active market. And I would expect that we were going to continue to see increased activity in that space. We've also, interestingly, and perhaps not surprisingly, seen consistent activity in the pharma, biotech, life sciences, clearly increased by the focused on this space as a result of the pandemic, vaccines, medication, all that good stuff. And so I would expect that momentum to continue in the next sort of 6 to 12 months. And as a subset of that, we've continued to see increased activity in the cannabis industry, and that's perhaps a more of a North American phenomenon and a Canadian one, but also in the US. And that's not necessarily just driven by the focus on the larger industry, but also just it's an industry that's had struggles over the past number of months, and the M&A activity that we're seeing is fueled by consolidation in the space, but also in certain instances by a continued expectation that the U.S. federal regime will ultimately remove the current restrictions on cannabis and allow cannabis multi-state operators to operate more freely without the restrictions that are currently in place. So that's an industry that we continue to monitor, and we're seeing good activity in.
Thanks, Alex. So let's pivot for a moment to where people are actually buying companies. 2/3 of our respondents based outside of North America cite the US as being one of the most appealing regions for buy-side cross-border M&A, far ahead of other markets. Their US-Canada peers, meanwhile, are especially keen to emphasize opportunities in Eastern Europe. That caught me by surprise. Where are you seeing buyers who are looking for potential targets, and what is impacting their decisions? Why don't we start with Alex on this?
Thanks, Tom. So I was certainly surprised by that result as well. When you think about Eastern Europe today, it certainly was, prior to the Ukraine conflict, an area that lots of prospective buyers identified as an area of opportunity, in particular given the relative value of assets and the somewhat evolving environment and the way that they're supporting businesses that are making inbound investments. But with the Ukraine conflict, I would have expected an exit from the space. But certainly, what we're seeing is risk-averse enterprises are looking to exit those markets, but that creates opportunities for more risk-tolerant buyers who are looking to seize those opportunities and secure a good deal. So that's something that we'll have to continue to monitor, but certainly promising, at least from the way that our respondents are thinking about it. From a Canadian perspective, I have to say we're continuing to see solid levels of inbound investments, in particular from US-based purchasers. That's a trend that has always existed, but it sort of ebbs and flows with fluctuations in our currency. But the Canadian dollar has remained relatively weak compared to the US dollar, based on historical trends, and that has continued to create opportunities for US purchasers looking to acquire lower cost assets in a stable market that's similar to theirs. And so we're continuing to see that activity driving M&A, even as we speak. I've started a couple deals that that are U.S. inbound deals. So it's good to see that type of activity continue.
Across the Atlantic and ask Darren for his thoughts on this. Darren?
Well, I'd love to tell you the UK, but I think generally at the moment, if you ask most people, I'd say they look at the UK with a little bit of circumspection at this stage. I mean, there's been a fair degree of political instability over the last couple of months. There's low rates of GDP growth, and of course, the challenges brought on by the war in Ukraine and the other factors we've talked about make it, someone said, not that attractive an option at the moment. But that said, and again, touching back on what I said earlier, there's a weak sterling and low asset valuations mean that actually the UK probably quite attractive to a particular type of buy, and that type of buy tends to be from North America. So I think we are seeing inbound investment from North America to the UK, and I think that will continue. Within Europe itself, I wouldn't say, in my experience, and again, the respondents are probably better placed than I am. I don't think we've seen particular hotspot jurisdictions. I think activity remains focused on scaling up across the continent and transformation wherever that may be. I would say that I think we've seen similar to what Alex mentioned earlier, I think we've seen a pullback by clients from some of the more emerging markets. It's a tough time out there. I think sub-Saharan Africa is pretty challenging at the moment. I think looking further afield in the east, in China and in India and other places, I think are looking a bit more. We've seen less activity, and therefore I think people consider them a bit more challenging at the moment.
Thanks, Darren. Rachel, this next question is for you. What dispute risks should buyers be aware of when considering cross-border or overseas purchases?
Thanks, Tom. And it's interesting hearing about the increasing interest internationally in certain areas. For M&A transactions, the main dispute risks are what I would call process risks and enforcement risks, and then regulatory risks. And on process risks, what I'm talking about there are the nature for how that dispute will be resolved and the dispute resolution process that parties work into their agreements. And while Andrea is going to speak shortly on the substantive risks on the screen in front of you, these process risks filter through every type of dispute. With parties coming from different court and possibly different legal traditions. Do they both want litigation before one country's courts over the other country's courts? Or is arbitration or some other ADR mechanism perhaps a better solution to what may come up given the subject matter of what they're dealing with and where they're located? There are obviously concerns with some court systems with respect to their independence, and ADR mechanisms, and in particular international arbitration, can then have a greater advantage for parties because you get a neutral location. You can have input into your decision maker who can have some skill or expertise in the subject matter at issue or the type of transaction. It's also a way to align multiple agreements easier. When you're looking at a transaction from the outset, perhaps there are potential supply chain issues, and where you might see a substantive issue arising in the future. If you can align those dispute resolution mechanisms in a way to get everyone who might be involved in that dispute before the same process, that can help to alleviate cost and time and duplicative efforts later down the road. Another example that comes up regularly is if you're in a technology situation where you might be looking at a potential breach of confidentiality and something being used inappropriately, or a dissipation of funds by the counterparty. Do you have that process that lets you act swiftly and in a way that you can enforce the result that you get? Which takes us to enforcement risks, because when you're operating internationally and taking decisions from different places or different decision makers or countries to another state to try and access enforcement relief, if the counterparty isn't forthcoming once a decision is rendered, you need that confidence that the process you have and the decision you have can be enforced. An interesting point here, international arbitration awards can be easier to enforce than local court decisions. So depending on the locations where the parties are likely to have assets, that might be a better alternative. It's a very nuanced area. There are some very specific enforcement considerations with certain countries, in particular in emerging or in riskier markets. And There can also be issues that arise if local courts are changing their view towards different processes. I'll touch briefly on regulatory risk because we're going to get into this later in the presentation, but depending on the nature of the investment that you're making or the transaction that you're entering into, you might want to consider investment structuring to alleviate regulatory risk and change that could happen, that could have a negative impact on your business and on your investment. That type of structuring is fairly easy to do at the outset. And when you take this all together and wrap it all up and have a process and you know, path to enforcement and covered off this regulatory investment risk, if it's applicable to you, then it also opens up additional avenues to enhance options for funding or financing of disputes that we're seeing internationally that are quite lucrative for companies who might find themselves in a worst case scenario.
Thanks, Rachel. Regardless of location, by far the greatest macro risk that cross-border deal makers are considering is the impact of rising inflation. And it was cited by almost half of all of our respondents as a top 3 point of concern. Andrea, are there measures buyers can take to mitigate risk related to inflation?
Well, with respect to inflation, unfortunately, I don't think any of us can know with certainty what will happen with inflation over the next several months, and I don't think deal parties can ever fully insulate themselves from inflationary risk. However, just echoing what has been talked about in a few other circumstances already, I think conducting a complete and comprehensive diligence process, both on the legal side and on the business and financial side as well, is important and probably one of the most beneficial ways to reduce inflation-related risk. I think it's beneficial for a buyer to have a thorough understanding of the target's current costs and supply chain, including detailed knowledge about the target's current vendors, potential alternative vendors, supply agreement terms. It's helpful to know if there is locked-in pricing, whether the supplier has the ability to change pricing terms on you with a certain amount of notice or without notice. There are any existing or expected shortages or surpluses and any other target or industry-specific supply chain challenges. I think if you have all of this information and know how it affects your target, it allows a buyer to make smarter decisions when negotiating the financial and other terms of the transaction documentation. And I think it also helps with the post-closing integration as well, so that they can appropriately plan on a go-forward basis. In the right circumstances, some other risk mitigation measures might be purchasing inventory and supplies in advance, or also considering financial hedging products. I don't think that's the right answer for everybody, but if in the right situation, it might be. Also, I think buyers can just consider being more conservative in their cash flow forecasts in order to just allow themselves some flexibility moving forward.
Thank you, Andrea. We've seen that acquirers are doubling down on protective measures that help them mitigate against unwanted outcomes in M&A. We heard a little while ago from Alex that rep and warranty insurance is one such solution that's available to them. Why is rep and warranty insurance an important tool in deal risk management? Andrea, why don't we start with you on this?
Sure. Yeah, I agree that representations and warranty insurance is a useful tool for managing deal risk, both on the sell side and on the buy side. On the sell side, it allows sellers to close deals with a defined limited amount of risk related to breaches of reps and warranties. And in some transactions, a seller may actually not have any liability for breaches of reps and warranties. Obviously, there are typically exclusions for things like fraud. But in those types of scenarios, the rep and warranty policy will serve as the buyer's sole remedy for damages. And And on the buy side, I think a rep and warranty insurance policy can provide a stable avenue of recourse for a buyer. It can really reduce or even fully eliminate the need to pursue a seller for damages and even multiple sellers in some situations. And in my personal experience, surprisingly, I have not found the rep and warranty insurers themselves to be unreasonably difficult to deal with when submitting claims. So that's also another perk for buyers. And just from a process standpoint, rep and warranty insurance really significantly streamlines the negotiation of the reps in the purchase agreement. Historically, negotiation of reps has often been the most difficult and time-consuming part of that. So it can really allow for a transaction to sign more quickly when you can cut out a large component of the document and focus the parties' efforts on other provisions. And in general, if there is an insurer standing behind breaches of reps, then the disputes between the deal parties is significantly reduced.
Thanks, Andrea. Darren, have you seen a rise in the use of rep and warranty insurance in your M&A deals?
Absolutely, although I would say the sort of London market in particular is really, aside from the US perhaps, has really been the heart of W&I insurance and M&A insurance over the last 10 years. So I think as compared to Canada, there's 5 years ago it was probably already quite advanced, but I'd say it continues to advance. And just by way of example, I mean, I think if you looked around the London market, say 5 years ago, there were probably maybe 5 to 10 insurers in the market who would insure these sorts of deals. At the moment in London, you're probably looking somewhere between 30 and 40 markets out there who pick up M&A insurance. So the market is significantly expanded. And I sort of struggle to think of the last formal auction sales process, or indeed the last PE deal where there wasn't W&I insurance or M&A insurance. I think it is certainly very prevalent, and that the respondents of the non-US Canada respondents saying 60% on the deal. I think that's probably about right. I'd say almost every deal with a PE element or a sales process use W&I, less so corporate to corporate sort of bilateral deals, but certainly in overall a lot of deals. And like Andrea, I think the UK market has now had an opportunity to experience some fairly favorable results on claims, which is always the big uncertainty a couple of years ago is, well, are the insurers actually going to pay out? And I think the last couple of years have shown there's been a significant increase in claims, but a significant increase in sort of positive feedback from people making the claims, which breeds credibility in the market and confidence in the product. So yes, significant continued increase in the product, and that's probably expected to continue.
Are you seeing similar effects that Andrea saw in terms of the impact on deals when it comes to negotiations and focus of the transaction?
Absolutely. I mean, I think you've got. I think the biggest trend, I suppose, is there's an increased focus on DD, which is not dissimilar to some of the stuff that Alex was talking about. But I think that people are now, advisors, clients are familiar with the product, and they really understand what it's going to take in terms of diligence to get the insurers comfortable. And therefore, at the outset, there's a lot more focus on what is the scope of the DD and is the scope going to be insurable or not? And so there's more sort of focus on that than there is at negotiating reasonables and materials and various other things in the reps and warranties, which as lawyers is a lot more fun. So in that sense, I think it's a very positive aspect. There's less sort of knockabout negotiation on warranty terms. But I'd say the other thing with the insurers is they're able to move pretty quickly, and I think from start to finish you could probably get an insurance policy in place in about 2 weeks. So you almost box the insurance, the warranty negotiation to a period of 2 weeks, which as Andrea correctly or says, and I think my experience is consistent, that really can streamline deals and can really solve some of the lengthy protracted negotiation issues you have. So the UK market has overall a really positive experience with the product in the last few years.
That's great, thank you. So the rep and warranty insurance takes a number of post-closing disputes off the table, at least between the buyer and the seller, but there are still some areas for dispute among the buyer and the seller post-closing. Andrew, what are you seeing as the most common types of dispute concerns?
Thanks, Tom. So yes, that definitely in my practice personally, most of my transactions do involve rep and warranty insurance. Most of my transactions are PE related. So as you noted, I'm not seeing a lot of disputes related to breaches of reps and warranties between the buyer and the seller parties. The one thing I might be interesting to note is with respect to rep and warranty insurance market studies, one of the types of breaches that is most common for claims under the policies themselves is financial statement reps, which I think historically is also consistent with what we had seen as practitioners in terms of disputes between the parties to a transaction. So taking aside the reps and warranties, since they are, as you noted, largely off the table in rep and warranty deals, the most common disputes I see relate to working capital and purchase price adjustments. It's always a matter of how one party calculated the current assets in one deal and the buyer disagreeing with what they were excluding and not excluding. The one thing I think is interesting to note here is Alex mentioned earlier, there is a rise in earnouts in transactions, and that is potentially a key risk mitigation tool that parties can consider using. I do think with the rise in earnouts that there will also be a corresponding rise in disputes relating to earnouts, because earnouts themselves are another form of purchase price adjustment. And they also involve complex language frequently, and those provisions may or may not be well drafted. So that alone can lead to a dispute. And the buyer's post-closing operation of the business is paramount to whether or not something is ultimately paid in an earnout. And a lot of sellers are going to contest and question whether the buyer met whatever standards were agreed to in the document for that post-closing operation.
Thank you, Andrea. Rachel, can I ask you to weigh in from the litigator's perspective on this?
Yeah, thanks, Tom. I agree with Andrea. The most common types of disputes arising from M&A transactions that I've seen are purchase price adjustment related, or the other matters that she's covered. We also saw governing law disputes and disputes over dispute resolution procedure on the earlier slide, and those are certainly also very, very prevalent, and tend to add an additional hurdle, because then you're in a dispute over how to even resolve your dispute before you get to the substance. I would add to that list solvency issues and matters involving cash flow. I have seen a fair number of those arising lately in a cross-border context, and I've heard a fair amount of speculation on an increase in rep and warranty and indemnity claims and disputes involving ESG matters, as there are increasingly novel provisions drafted into agreements around matters of ESG. However, with that rise in insurance, it'll be interesting to see how that resolves itself over the near and long term. On the slide in front of us, there are the survey results on which type of dispute resolution mechanism the organizations surveyed were most commonly to use or most likely to use. And there's certainly nothing surprising in this. Aside from the extreme preference toward dispute resolution boards, of course, there have always been many options for resolving disputes, and there is nothing new in any of the options in front of you. It's interesting that litigation is also still so high on the list. The other ADR mechanisms can sometimes, again, just assist in getting that skilled decision maker who might have some industry insight and expertise, and using those other ADR mechanisms can also help to move towards a settlement earlier, before a lot of cost and time and expense is sunk on the dispute. With respect to binding mediation, there are also new global guidelines on the recognition for mediation and mediated settlement agreements. which could be interesting going forward from a global perspective. Canada isn't a signatory to that convention yet, but for those involved in disputes in other countries, that might make mediation an even more attractive option going forward.
Thank you, Rachel. We do have some questions that have come in, so we're going to do one more prepared question, and then we'll turn it over to the Q&A. For this question, I'm going to start with Alex. Alex, how is the shifting regulatory landscape expected to impact deal making? And in particular, I'm thinking about changes to foreign investment regulations and ESG requirements.
Thanks, Tom. I would say that the evolving regulatory regime is likely to play an increasingly significant role in M&A activity. And you mentioned foreign investment. There's been a bit of a interesting development over the past 24 months, partly driven by COVID, where we've seen increased regulatory scrutiny and changes to the foreign investment regimes of various countries almost aligning themselves with each other, that have made it increasingly more challenging to conduct cross-border M&A. Lower review thresholds were implemented during COVID to protect the healthcare system and the supply chain that's related to that. And the scope of review under national security considerations has been expanded. It was always a relatively nebulous concept in a lot of jurisdictions, but the waters have been further modeled by regulators who sought to increase their broad discretion to reject or modify or seek specific undertakings from parties to M&A transactions. And I think that's here to stay for a little while. This is likely going to increase the complexity of transactions, but we're not actually expecting that this will ultimately impact overall deal volumes. Most transactions end up being approved after the regulator completes its process, and it's really only a small percentage of transactions that are ultimately blocked or that require significant concessions. So it's more of a cost and time consideration as opposed to, am I going to do this deal or not altogether? From an ESG perspective, we've seen some M&A activity driven by increasingly complex and onerous environmental requirements, for example, where certain market participants are looking for an exit. It's becoming increasingly challenging to comply, and the cost of that isn't making the investment worth it anymore. But for the most part, this is an area where we've just seen added complexity to the process, enhanced due diligence processes, that are focused on ESG matters, ensuring that you're ready to continue to comply day one post-closing, and including with respect to any reporting obligations you might have. And so while we haven't seen this to be the driver of significant activity, it's clearly an area of increased focus. 80% of the survey respondents have clearly identified this as an area that's going to be more impactful over the next 12 months. And, it's certainly identified as a key area of focus in due diligence by more than 40% of respondents. So it's clearly on people's minds.
Thanks, Alex. I know Darren and Andrea had some thoughts on this, but given the number of questions we have in the Q&A, I'm going to just skip over that for the time being. And if we do have time, we can come back to it. I'm going to start with the first question in the order at least they arrived on my desk. And the question is, are you seeing more what used to be considered due diligence tasks and post-integration thinking occurring prior to signing a letter of intent?
Tom, I can take that. So I wouldn't say necessarily prior to signing a letter of intent. Often letters of intent are non-binding. And so while there's some preliminary due diligence and thinking that happens prior to that letter of intent, the assumptions that go into it often get validated between that process of signing the letter of intent and the definitive agreement. But I am certainly seeing more thinking around those issues in that period of time where you're negotiating a definitive agreement, and it's certainly forming part of the due diligence processes that take shape in that period of time. So certainly prior to signing a definitive, whereas it used to be a kind of thing that people thought about after you've signed a definitive agreement. Okay, what do I need to do now to get this business ready for closing? And that's probably a little bit too late. So we're definitely seeing more thinking around that in that period.
And I'd say maybe just jump in there. So I'd say particularly around some of the ESG issues we talked about. I mean, I think historically some ESG issues were seen as kind of post-completion integration items or post-signing integration items. But I'd say from our side, we're seeing a lot of those being sort of moved up the chain a little bit and pushed into the the pre-signing DD exercises.
Andrea or Rachel, any further thoughts on this? The next question in the queue is, where there is rep and warranty insurance in place, is it common to include a provision in the purchase agreement to the effect that the buyer's recourse is limited to a claim on the insurance, meaning that the buyer would have no claims against the seller? Andrea, why don't we start with you on that?
Sure. So is it common? It is common in certain types of transactions. I would say in auction processes involving, a private equity sponsored target, that's going to be a common situation. At least historically, it has been the way the market was. If there's a decline in the market, whether or not that deal term will continue, it's hard to say. But I would say what is a more typical rep and warranty arrangement would be for the buyer and the seller to split the cost of the retention under the rep and warranty policy itself. And then after that retention is satisfied, then the insurance comes in. And after the insurance hits its limit, there may or may not be further recourse to the seller. It just depends on the transaction itself. And then, of course, if there are specific risks and concerns, those are items that are going to be carved out of the policy and for which coverage isn't going to be available. So it is common for parties to then negotiate a separate indemnity for those particular risks that are carved out of the policy, in which case then the seller will have liability for those matters.
Andrea, just before I shift to Alex for the Canadian perspective and Darren for the UK perspective, you did mention a buzzword that I know we all use all the time, retention, but that might not be known by everyone in our audience. Do you mind just briefly defining what you mean by that?
Sure. It's just in the rep and warranty policy world, that's just the insurance deductible. So when I'm saying split the cost of that, it just means if there is a claim that is still within the deductible, then it's which party is going to bear the liability for it. If it's the seller, you will often see an indemnification escrow set aside. So that the amount of the escrow will typically then be the seller's portion of its liability for the retention or the insurance deductible.
And I know, at least on my deals, when that's in place from a seller's perspective, that retention typically is hovering around about 0.5% of transaction size. It's a much smaller escrow than there would have been in place had there been no rep and warranty insurance.
Yes.
Alex, Canada, similar to the US, a little bit different. What are your thoughts?
As I think I mentioned, we certainly look at the UK and the US and we model ourselves afterwards, but we're just a few years behind. So to the extent that, vendor walkaway policies are more prevalent in those markets, that hasn't been the experience in Canada, although it is increasingly more so in certain deals. I wouldn't say it's the majority of deals, but certainly there's a push in that direction, similar to the push you see in evolving our indemnity protections to be more closely modeled around the US model, which is a little bit more seller friendly than it has been historically.
And Darren, how about the UK?
Yeah, very similar to Andrew's view in the US. I think it's, over the last 2-3 years, the sort of no recourse policy, as we would call it here, where the sellers have no recourse and the buyer's entire recourse against the policy has become a lot more prevalent, definitely standard on PE type transactions. It was historically, you could only really get that on a sort of real estate deal where there's pretty limited risk, but that, the last 2 years that's expanded out to most sectors. So bar one or two specific ones, I think, that or recourse equal to the deductible is pretty much what we're seeing here.
Rachel, the next question from our audience is directed at one of the portions of your presentation. What is a dispute resolution board and how does it work?
Sure, yeah. At a high level, it's similar to the concept of a standing neutral. There is a person or a panel of 3 people who are tasked as the dispute board. And this is something that's been used in a construction and infrastructure context for quite some time, where that board is put in place early on in the project to be the sounding board for disputes as they may arise. And it can take a few different forms. There can be a dispute review board that is more advisory, that can be empowered to even warn on where they see disputes coming down the road so that the parties can act appropriately and issue recommendations only that may or may not become binding. There's also a more adjudicative, aptly named dispute adjudication board, where they take on a role more like a standing arbitrator, something like that, where the parties can repeatedly go to the same person to get, or same panel to get quick decisions. That person having been there, or that panel having been there since the start of the project, is up to speed. They know what's going on, and they are able to then act quickly at the pace of business to keep matters moving forward and not prevent a stop or a bottleneck the way that other forms of dispute resolution sometimes can. There are several different forms of rules and institutes who have their recommendations and guidelines for dispute boards. And while I did mention, primarily in the construction and infrastructure context, they are rising in popularity in IP and pharmaceuticals and biotechnology and research and development type agreements and arrangements.
Rachel, have you seen dispute resolution boards used relating to M&A in Canada?
Outside of an infrastructure or construction context, I have not, no.
Got it. Thank you. Just looking at the clock, I think we are almost out of time unless Darren and Andrea have some very, very brief comments on some of the regulatory risk or ESG risk that they're seeing on deals. I'm not seeing anyone coming off mute for that. Well, thank you to our audience and to our panelists for joining us today. We hope you found this session valuable. I know I did. The recording of this presentation will be sent to you post-event shortly, and we hope to see you again soon. Have a great day, everyone.